two pros and two cons to investing in private equity. Pro number one, better return than the publicly traded equity market. For the last 5, 10, 15, and 20-year periods, the PE Global Index has outperformed the MSCI World Equities Index by a pretty significant margin. Pro number two, private equity has a lower standard deviation than the S&P 500. Standard deviation being one of the primary measurements of volatility. So you have an asset class that over time generates a better return than the public equity markets and also has less volatility. Con number one would be liquidity. Private equity is much less liquid than publicly traded equities. When you own a stock, you can immediately sell it same day and create liquidity. Private equity funds, you're not able to do that. And that's why often that premium that you're generating through private equity is often called your liquidity premium. Con number two is that oftentimes private equity really comes down to manager selection. There's lots of private equity managers out there in the space, and there's a wide variance of performance across managers. So it's really important, especially because private equity is not regulated like the publicly traded equity markets, that you choose the right manager. Oftentimes that may mean going with one of the largest, best managers in the space with the longest track record.